Hey there, Teresa Timms, president of TDR Mortgage Real Estate Group. Thanks for joining me today. I want to update you on the important topics that I feel if you're in real estate, mortgage, or an affiliate industry, you really need to have the skinny. I've been following several news sources to come up with this information, and the amount of information flowing out of all of the sources is incredible right now. So this is about 2 weeks of me paying attention. So I want to share with you this important stuff. Okay, this is largely geared to the realtor agent community. So I wanted to start first with forbearance. So when we were first reporting on forbearance, we were letting people know that forbearance is much like a foreclosure, affects your credit like a foreclosure. And when you file forbearance, all 4 payments are due in 4 months. So it's turning out that that isn't all the way the case. And there's so much misinformation and misunderstood information out there that you're going to have to do some sleuthing on your own to figure out what you're eligible for. Keep in mind that forbearance is still considered, no matter what happens, a major credit event, and you will not be able to get loans if you have a forbearance. Traditionally, it's 3 years for FHA and 7 for conventional. This is a major credit event and should only be used and exercised by persons that are unable to make their mortgage payment, as it's not something that's to be used or should be used as a way to pay bills and just not make your payment. The way forbearance is being handled differently depending on the different loans. I'm going to use myself as an example. I have 3 mortgages. I did regular conventional loans, refinances back in 2011. It turns out those are Fannie Mae mortgages. Fannie, Freddie, like regular conventional FHA loans, are going to fall into a different category than other forbearance loans. So you, as a consumer or as an advisor, you're going to have to get out there and do some digging. Below, I have a website by a website link. One of my friends, Scott Shang, one of my super smart friends. I have like the best friends, and he said, hey, just use my stuff all you want. I don't even know how he found time to put all this stuff together, but the link is down here. It has the Fannie Mae lookup tool, the Freddie Mac lookup tool, and it has the different criteria for FHA, VA, conventional. So my 2 loans were just like vanilla traditional loans. Those are Fannie Mae. And those loans are going to qualify for some type of, following the CARES Act, you can forbear your loan for 12 months. So what we're being told, and it could change, is that it's possible that we're going to have a second mortgage that's going to stick along with the forbearance, so that Mark Calabria, the FHA director, came out specifically and said, we are not going to make these lump sum payments due for these folks in 4 months. I mean, that would be catastrophic. So they came out with guidelines, which are really great to help people understand their rights under the CARES Act. However, it's still extremely confusing. And so anybody that's looking to go into this or use it as an alternative, not pay your mortgage, really needs to be to understand the consequences. So last month I urged people, don't do it. Don't go into forbearance, because we still don't know all the consequences and all of the ways that we can enter into this safely. And so now going into this month, there's a lot more information out there. So if you are a family member or a client are considering it, you can enter into this major credit event with a lot more information. So the only way these past due payments are going to be paid back is going to be by a balloon payment at the end, right? Like everything's due at once, or they're going to spread that forbearance over time, or they're going to modify your loan, or they're going to do some kind of second mortgage. So we're not like 100% certain how that's all going to play out. What we do know is that the amount of forbearances are causing quite a bit of havoc in mortgages, and the non-banks and the servicers are taking on a big brunt of this because the GSEs, basically the entities that buy these loans, the mortgage-backed security investors that buy these loans aren't going to be buying loans that are in forbearance. So right now there's about 8% of the loans in forbearance. Fannie Mae came out and expected 15% of the loans are going to be in forbearance. So if they're predicting that, it's probably more like 20. That's an incredible amount of loans to be in forbearance. And so while we don't know exactly how this is going to affect lending, I, for one, am preparing and gearing up for the time when there's a possibility that there may be no loans out there for people unless they're putting a huge amount down. So this forbearance policy could put these companies out of business. And there's just so much uncertainty, such an incredible amount of uncertainty that moving forward, you just need to save as much as you can and just tread very, very carefully. So, okay, so that's the forbearance stuff, and there's information below on how to look into that. Loan programs, the real deal. Okay, so so I'm a mortgage broker. I can't do loans below 640 right now on FHAs, and the reason is because the pricing is terrible. So I've got, let's say you got a 630 FICO, I could do it at 4.25. But then the borrower has to pay 3 points, and that's me making zero money. And then they have to pay closing costs. So basically, I literally cannot do a loan below 640. So when I get a borrower and they have like 600, 620, usually I like to get them up over 640 anyway. So also, there are new overlays for self-employed people. They have to have 6 months reserves. Jumbos are gone. HELOCs are gone. They're being extra strict on cash out refinances. This is across the board 100%. So with every lender. However, you do hear some people saying, hey, we're business as usual over here. We're not affected by this. We're still lending down to 580 FICOs. And don't be fooled that they're not also burdened by the market and the market activities. For whatever reason, they have a source that still has money available for these high risk loans. How long they'll be able to make these loans, I don't know, but I would just tread extremely carefully when you have a client below 640 closing. So I could broker. So I know Sunwest. I'm hearing that Sunwest is a lender that's doing these under 640 FICOs. I'd rather stick a hot needle in my eye before I brokered a loan to Sunwest. So on the retail side, maybe there's some really great loan officers that work for Sunwest. I know on the wholesale side, that has not been my experience. So one of my investor friends he called me because this borrower had like a 620 FICO. And I said, look, the only person I know doing them are Sunwest. And that's who it was. So I told him, well, good luck. And, it's going to take at least 45 days. And most loans are taking, I feel like it's safe to say 45 days. However, we are able to close stuff in 30 days now. We're kind of getting back to a much more normal cycle. And the appraisals weren't really that bad, right? The delay in appraisals, like appraisers were able to absorb all of the COVID changes pretty rapidly. So I was very, very impressed by that. What else? So on the loan programs, okay, think about this though too. When Jumbo's being gone. So anything like LA Orange County has that high balance, right? To like 760, whatever, or 780, I always forget. So LA Orange, you're good. San Bernardino Riverside, the non-high cost areas, your loan limit is 510. Anything over that is jumbo, and there's no jumbo. So if you have a house for sale for 750 and nobody can get a loan unless they get a loan of 510. So they have to come in with a difference in cash. Now, I have heard of some lenders having jumbo, but it's 15% down. And like, you need like a 740 or a 760 FICO. It's like a 35 DTI. So the amount of people that can qualify for that jumbo loan is like this many. And what happens is when you reduce the buyer pool, so low, then what happens to demand? All of a sudden you have this many people wanting houses and can buy, and now you're down to this many people wanting houses and can buy. So that's going to decrease demand. Decreased demand decreases price because if you don't have the demand. One thing about the Inland Empire that they have the advantage over, and very affordable communities have a huge advantage, is affordability. So the Inland Empire realtor and people that concentrate out there, a large portion of the inventory is under that, 525, 530 conforming sales price and the 458 FHA sales price. So I feel like while they're still going to suffer price declines and negative impact from COVID, that they're going to have the most opportunity to rebound the fastest. Okay, so I wanted to give you some newsletter and database tips. When I'm putting together a video, oftentimes, like, this is my scribble. Like, I scribble stuff down, and then I have articles, and my sources are like the OC Register. Yeah, the OC Register. There are a couple writers in there that I feel like they have great information. And then my people, Frank and Brian, with the National Real Estate Post, Bruce Norris, all of my lender friends and big company owners that run these big, high level companies. I follow them. And then what I do is I just kind of regurgitate everything that they are saying and just kind of frame it and put it in my own words and put my take on it. I'm not afraid to say what I think. And I feel when you're a real estate agent and you put yourself in a power position, right? You're a resource to your clients. You shouldn't be afraid to say what you think. And sometimes when you say what you think, you're wrong, right? Nobody has a crystal ball. Nobody is 100% right. But you have an audience that tunes in. Just like on this video, there will be people that are listening to me. And so if someone's going to actually take the time to listen to you, they're going to not take every single thing that you say like to 100%, but it's also going to help them form an opinion of what they should do. So, get out there. Like right now, people are craving information. And if you're the only one in your family that's a real estate agent, well, who best to advise your friends and family but you? I'm going to be putting together a database, like a super easy, no-brainer database, because I still can't believe how many of you do not have databases. And I know you don't, because when I call you and ask you, you just get so caught up in the minutia of actually doing it, right? The technical part of, how do I do it? So I'm going to break it down in like 3 super easy steps. The videos will only be like 5 minutes. And we're going to get you a database going in the next couple of weeks. Okay. So I'm going to help you with that. And then, start thinking of like topics and ideas that you could send out to people based on all the different things that you learn and you read about. So we're going to do that. Okay, what else? Okay. So I think that's all the stuff that I wanted to cover right now. And it's a lot of information to take in, but I urge you to read my friend Scott's newsletter or blog post, because it's really broken down incredibly easy. And then it's a way for you to share this information to your family and friends, because this forbearance thing is really, really bad for people that don't need it. For people that need it, it's amazing. It's a lifesaver. It's, some peace in an otherwise, crazy time. So I'm happy that they're making it so easy to get. but that's also one of its downfalls is you just make a phone call and bam, you're in forbearance. And one of the things that we've been hearing is that people have been doing online inquiries and all of a sudden go into forbearance and they're in an active refinance. Well, refinance canceled, credit scores plummet 100 points. It's really, really bad. I just talked to one of my lender friends because I was sending a loan. I just wanted to kind of make sure about their appraisal waiver procedures. And he told me even people that are doing credit card deferments and auto deferments, they're getting the axe. So basically, lenders are going to be like, hey, if you can't pay your credit cards, you can't pay this, you can't pay that, I don't want to give you a loan. And I mean, can you blame them? Because they're going to be on the hook. They're going to lend money on this refinance. And then their fear is that they're going to lend this money and then the borrower is not going to make the first payment. Or maybe they'll make one or two payments and then they go on forbearance and they're on the hook. Conversely, if I make a loan, I'm on the hook. If that loan goes into deferment or first payment default within the first 6 months, not only do I pay back all of my commission, which, who wants to do that? But I pay penalties and fines. And it's really, really a bad gig. So it's bad for everybody. However, for the people they need it, it's literally a godsend. So let's get out there and be resources to our community, to our past clients, to our friends and family. And I'll put out some information on when I'm going to do that database thing, get those databases going. And y'all have a wonderful, wonderful weekend and wish you the best. And if you have any clients looking to buy, sell, or refinance, please pass along my number. And, I partner with realtors and provide realtors buyer leads. So if you're an experienced realtor with at least 2 to 5 years of experience and are looking to partner with a really strong mortgage broker, reach out to me. I'd like to see if we could work together. Have a nice day.